Welcome, everyone, and Happy New Year. Unless, of course, you happen to own stocks, bonds, currencies, commodities, or real estate. Wow, what a beginning to 2016, and obviously a lot that we have to talk about today. Actually, it is a Happy New Year if you're an investor in U.S. money market funds because the rates are actually above zero. Hard to believe that you'd celebrate rates above zero as the only bright spot out there. But in the past quarter, we've dealt with the Federal Reserve rate liftoff in the U.S., volatility in the debt and equity markets, diverging central bank policies, widening credit spreads, liquidity shortages in certain areas, and that's just to name a few of the topics that we'll be discussing today. I'm Tony Carfang, and I'm a partner at Treasury Strategies, and as you know, we consult with corporate treasurers and financial institutions in the area of treasury, payments, and liquidity. I'm joined today by my Treasury Strategies colleague, Kevin Ruiz, as well as three distinguished panelists, Debbie Cunningham, Chief Investment Officer at Federated Investors, Peter Matza, Engagement Director at the Association of Corporate Treasurers, and Roger Merritt, Managing Director at Fitch Ratings. Today we'll discuss the changes in corporate cash levels as well as the key issues I just mentioned above, which are top of mind for corporate treasurers. As a quick aside, everyone who's registered for this session in a day or two will receive a copy of the presentation and a link to the recording on our YouTube channel. We invite you to visit our YouTube channel at your leisure. Just go into YouTube and search Treasury Strategies. We'll be at the top of the list. If you wish to ask any questions or share any comments, you can do so in the question box at the bottom right-hand corner of your screen. We'll handle these questions offline when the cash briefing is done. And I'd like to give a special shout-out to some special guests on the line today, the MBA class from the Kelley School of Business at Indiana University, and their professor, DJ Masson, is joining us today. Welcome, all of you, and we hope you enjoy. In today's briefing, I will review the changes in corporate cash levels and central bank reserve levels over the past quarter. Kevin Ruiz will take us back on a quick tour of 2015 and what we had identified as game changers each quarter in 2015, and how had you heeded those game changers, our corporate treasury and financial institution clients would have benefited. Today we're going to discuss four specific game changers we see as key issues going forward, and a roundtable of Debbie, Roger, and Peter from Federated, the ACT, and Fitch Ratings will be leading this discussion around diverging central bank interest rate policies, the regulatory landscape affecting corporate treasury, widening credit spreads, and especially the impact on high-yield debt, and foreign exchange volatility. So let's just get right into it. We have a lot to talk about today. And in terms of corporate cash levels, corporate cash around the globe continues to increase. Actually, in the U.S., that seems to be the outlier. And quarter over quarter, we've had a 1% drop in U.S. corporate cash. Year over year, a 1% increase. So we've actually seen a multi-quarter tapering in corporate cash in the U.S. That's not true around the rest of the globe. For example, moving to the right in the UK, quarter over quarter, we're looking at a 4% increase, and year over year, an 8% increase in corporate cash held in the UK. In the Eurozone, this past quarter's increase was only 1%, but year over year, it's up 6%. And similarly, in Japan, a quarterly increase of 1% and year over year of 5%. So cash continues to move. Now, for those of you who were with us last quarter, you saw that we began to do some statistical analysis of what was driving corporate cash, and you may remember regressions against interest rates, other economic variables, a whole number of things that we tested, and one of the strongest relationships was with time. And it simply seems, and you can see from these charts, that the trend line is very consistent over time. In fact, the R squared for for the U.S., the UK, and the Eurozone, which measures how well one data set describes another data set, is 0.94. That's almost a perfect correspondence, meaning, 0.94 in the U.S., 9.7 in the UK, 9.8 in the Eurozone. That tight fit indicates that corporate treasurers are adding to cash at a fairly consistent basis each quarter on the data set that goes back to the beginning of this millennium in January of 2000. We obviously see Japan being an outlier here, and you'll see that through these charts. Now, as we look at corporate cash as a percentage of GDP, again, over the 15-year period, we see a modest increase from 9% of GDP in the U.S. to 11%, but we've seen sharp increases everywhere else in the world. In September of 2000, corporate cash on the balance sheets in the Eurozone equaled 14% of Eurozone GDP. That number is now up to 22%, up from 21% last quarter, by the way. UK from 24 to 32, and Japan from 37 to 51. That is a significant increase, and it does show divergence both in terms of the amount of cash it takes to support a level of GDP, as well as the rate of growth in cash relative to GDP around the globe. In fact, on the next chart, we actually show a correlation between cash and GDP, and you'll be able to see this in great detail when we email you the deck later. But you can see, again, the very high R-squares for everything except Japan, where cash is actually negatively correlated with GDP. But focusing on the U.S., the UK, and the Eurozone, what we see is a 0.95 degree of fit and a slope. If you see that 127 billion per trillion, what our regressions have shown is that for every $1 trillion in new U.S. GDP, corporate cash increases by 127 billion, which is about a 13% rate. Whereas in the Eurozone, that rate is 39%, and in the UK, 42%. So in these three jurisdictions, we actually see treasurers behaving and bankers behaving somewhat differently, and this may have a lot to do with the relative participation in capital markets. This may have a lot to do with the regulatory structure, and it certainly has a lot to do with central bank activity. But the point is, again, independent of changes in economic behavior or interest rates or inflation or other variables that we regressed, these relationships against time and against nominal GDP appear to have been the strongest and tell a very interesting story. The final set of statistics I'd like to relate to you today are the reserve balances at the four central banks that we watch very closely, and to point out on this chart the extent to which each of these jurisdictions' central banks are diverging in their policies. And it's that divergence that our clients, our corporate treasurers are very concerned about. Most of you operate global enterprises now, and diverging central bank policies impact exchange rates, it impacts asset price levels and commodity price levels, and that's probably one of the biggest question marks out there. You can see in the U.S., the Fed began to taper about 2 years ago and then ended quantitative easing a while ago, and we're beginning to see that impact on the Federal Reserve balance sheet. The Bank of England had actually been flat for a couple of years, but we've seen a huge drop this past quarter. We've double-checked the statistics. That is correct. We believe it has something to do with the movement of deposits through different accounts at the Bank of England. We're still investigating that. That does represent, though, a significant change in policy if that's in fact what it is. Going down to the bottom left, you know, the ECB tends to move in opposite directions, and quite a roller coaster. So when Mario Draghi announced, you know, we're going to do whatever it takes and drive interest rates as low as we need to go, we can see the spike upward on the far right-hand side of that chart. But if you look back, you know, since the financial crisis, we see, you know, what looks like a schizophrenic graph there, and that certainly raises question marks for corporate treasurers. Like, you know, how can such a major global economy be growing at that rate or inflating its balance sheet at that level while the U.S. and the U.K. are not? When we move over to Japan, we almost see you know, the tale of two economies here, where from the first part of the financial crisis through 2012, reserves were actually at a very small level, under 50 trillion yen, and are now up over 200. So we're seeing you know, just an astronomical increase there. So we have a lot going on, a lot of divergence. So what I'd like to do at this point is turn the chair over to Kevin Ruiz to kind of review what we thought were the important issues of 2015 that we presented to you along the way, and share with you how they came out. Kevin.
Thank you, Tony. In the interest of spending as much time this quarter on the Q1 2016 game changers, which our panel is going to talk about in just a few moments, I'm going to quickly go into reviewing the game changers from our previous 4 quarters from 2015 and focus on the things that we feel we discussed which really provided value to our corporate treasury clients in 2015 and continue to be top of mind as we go into 2016. As we look at the first quarter, one of the things that we initially talked about was the implementation of Basel III, the changes to, you know, the introduction of LCR, and the things that were directly going to impact the global banks. But at the time, we were not seeing a lot of reaction from our corporate treasury clients. As we've gone through the year, we have seen our clients realizing that, yes, Basel III does have an impact on corporate treasury as it cascades through the banks, and those policies cascade as well into our corporate treasurers, and they are looking on more and more on where to park their deposits. The other thing from Q1 that was extremely important and continues to be important to even today is the drop in oil prices, and that comes from a lot of issues. You know, that comes from oversupply, that comes from a reduction in demand from China, it comes from movements, you know, and instability in the Middle East. And even now, we're looking at things that are going on with Saudi Arabia, looking to float some of the shares in Saudi Aramco. This is something that continues to be top of mind, not just to corporate treasurers, but to the global economy in general. As we look at Q2, we felt like the two things that really provided value to our clients from this were one, the banks trimming those deposits and lines of business, which directly comes from the Q1 Basel III implementation and LCR. That has cascaded down to our corporate treasury clients as well. Just had a conversation about this yesterday with one of my clients here in the United States. And second, for the second quarter of 2015, is the diverging central bank policies and the resulting volatility in exchange rates and asset prices, as Tony just mentioned. This again continues to occur as we've begun to increase interest rates here in the United States at the Fed Reserve, and other central banks have gone in the opposite direction. As we look at Q3, as we get closer and closer to the present day, we can see that the issues that we talked about in Q3 continue to resonate today. The Greek debt crisis at the time was important and continues to be important for Europe in general. That's starting to become more of a snowball, not just because of the economies in Europe, but also the situation with refugees coming into Europe and the resulting instability there. The second game changer, and I would consider this to be maybe the biggest one that we've talked about in 2015, is the volatility in China. You know, we saw a devaluation, whether the the PBOC wants to call it that or not, we saw a devaluation of approximately 2% in the renminbi sometime in August, I believe, and we're seeing issues occurring even today with China. And what we think is happening, and I guess I should say what I personally think is happening, is the PBOC is spending down reserves faster than I and maybe anyone I know of even anticipated, and perhaps faster than the PBOC even anticipated. The responses to that are falling markets, not just in China, but as we all know globally, and it's made it, not just domestically, but offshore in Hong Kong, it's made it harder and harder to sell within China. It's harder and harder to sell and engage in those markets. And more importantly, it's eroded confidence that China was trying to instill in its people and in its leadership by getting the renminbi included in the IMF SDR basket. That was a signal that the renminbi was going to be a stable global reference currency, and we're not sure if that's going to be the case going forward, at least not right now. But the key thing to me regarding China is this. More and more people, both in and outside of China, are questioning whether the government is as in control as what we had thought they were with regards to the markets. And do they really know what they're doing from both a domestic perspective, but also in terms of how those are impacting markets globally? You know, capital flight's not just a domestic problem anymore, and we're seeing this volatility occur throughout the marketplace. Finally, in the third quarter, we're seeing, you know, the chase for high-quality liquid assets, which is another important thing that's cascaded down to our corporate treasurers. As we look at quarter four, bond market volatility continues to be an issue. This is something that we saw in the Wall Street Journal headlines all week long this week, and it's been occurring for weeks. And then, of course, I don't know what the term is for the opposite of the elephant in the room, but global market volatility is certainly something that we are all thinking about. We were just talking about this as a team right before this call. So with that, I want to turn to our panel to discuss the game changers for the first quarter of 2016. And Tony, I'll let you take over.
Thank you, Kevin. Today we're going to talk about four primary game changers: foreign exchange volatility, diverging central bank policies, credit spreads, and the regulatory landscape. As I mentioned earlier, we're joined by Debbie Cunningham, Chief Investment Officer at Federated Investors, Peter Matza, Engagement Director at the ACT, and Roger Merritt, Managing Director at Fitch Ratings. And we're going to kick off with the FX volatility, and I'd like to ask Peter, you know, to discuss sort of the landscape that he sees from his perspective at the Association of Corporate Treasurers, and get into issues like the you know, is there an impact with commodity-based currencies that's different than other currencies around the world, and you know, how the China question is impacting this, and the whole set of things that, Peter, I know you and I have been talking about regularly over the past quarter. So, Peter, if you'd like to pick that up.
Good afternoon, everybody. I think it's an interesting circumstance we're in here. Corporate treasurers in the UK have traditionally been very used to the idea that their currency has been particularly volatile, although if you are perhaps as old as I am and you have a long enough memory going back 10, 20, 30 or more years, traditionally sterling is a currency that depreciates against everything everywhere all of the time. And basically the graph runs from top left to bottom right and never seems to stop. Having said that, however, what I think is interesting at the moment is the volatility here is not just, if you like, it's not a bilateral exercise. This is not just sterling and dollar volatility, or, for example, it's not just dollar Mexican peso volatility. What you've got here, somebody likened it to me the other week to an exploding box of fireworks. There is stuff going off in all different directions, and no one's quite sure what the drivers are, what the outcomes are going to be, and where it's going to end up. Now, traditionally, as I say, sterling's been a depreciating currency, and for example, from a European perspective, certainly the franc, and to a greater extent as was, and the Deutschmark as was, now the euro has been technically an appreciating currency against sterling. those days are gone. We don't quite know where that's going. You've got hard Northern Europe and soft Southern Europe. They're all trapped in one currency. You've got emerging market currencies. An analysis I saw the other day on BRIC currencies. Well, there aren't any BRIC circumstances anymore. Russia's under sanctions. Brazil clearly seems to be having all sorts of problems. They're spending money like water on their sporting events, money they don't have. That's having a knock-on effect on their currency, of course. From a corporate point of view, is this a case of beggar thy neighbor? Potentially it might be. We can't all export our way out of a problem, and somebody needs to accept the fact that their currency has got to appreciate for everyone else to be potentially a winner against their losers. I think that's the thing that corporate treasurers certainly, can't speak in the US, but certainly in the UK, continental Europe, we've been used to some volatility, but I think it's the fact that you can't pinpoint a particular area or a particular circumstance. If it is China, if it is India, if it is Brazil, is it oil driven, is it commodities driven, who's it good for, who's it bad for? Take Switzerland as an example. They've had their problems, and the Swiss central bank has spent fortunes on trying to keep the currency at a point at which they can export. But the fact of the matter is, people wanted that safe haven, and therefore there was nothing much they could do about it. I think Kevin's point about the renminbi joining as an SDR was an interesting one. That was supposedly, and certainly the message we got when we ran our conference in Hong Kong back last September was, this should do good things for the position of the currency. Well, clearly the last 3 months have said no one quite knows what that statement was for, and it wasn't true then. It would now seem, and it certainly isn't true now. So I think what corporate treasurers are faced with is a marketplace that's consistently moving, a marketplace that's not moving in obvious correlations, and a marketplace where, purely speaking from a corporate treasury point of view, technically point of view, the ability to do one's hedging is constrained by the different regulatory regimes, by the different derivatives regimes, by the issues of corporate credit extended from banks and other players in the marketplace. So there's a much messier picture, it seems to me, and that we're seeing in terms of foreign exchange management at the moment.
That's fascinating. I'd like to go on to Debbie as Chief Investment Officer at Federated and managing a couple $100 billion in assets. Many of our treasurers are investors as well. How do you play the volatility situation? What are you thinking about?
I mean, essentially, we're attempting to provide, the return that's available in the marketplace for cash investors. You mentioned at the beginning, Tony, that rates are not zero any longer, so that's a good thing. And probably from a corporate treasury perspective, the biggest competitor for money market funds for the cash of those corporate treasurers comes from the banking market, CDs, because we've had a rate increase and money market funds have subsequently begun to increase what they're paying and, where their rates and returns are, banks have been a little bit stickier at kind of staying with their payments at this point. So that's been more of an impact at this point to our industry than the volatility in the FX side has been.
And Roger, with all the volatility, does this change the lens through which you do your credit ratings?
Well, certainly volatility usually results in winners and losers. So, one only has to look at the high yield market and to see that, both in terms of prices, but also default rates and distressed debt exchanges. So, when we look at the high yield default rate at Fitch, on average in the U.S. it's approaching 3%. But it's really a tale of two cities. That's the average. Really, what's driving that is a couple of sectors. The metals and mining sector is closer to 10% trailing 12 months default rate, and the coal sector is up to about 27% on a trailing 12-month basis. So clearly, those two sectors are directly exposed to what's happening in the commodities/energy sector, and they're feeling the effects.
Thank you, Roger. Let's move on to the second game changer, the diverging central bank policies. Rates, the Fed just lifted rates first time in, I don't know, 30 or 40 quarters. The European Central Bank continues to ease. Debbie, you're excited about actually having a rate in your U.S. money funds. I'm not sure that the same is true in Europe. Share with us your forecast of, first of all, the Fed and what you expect it to do over the next year, and then the other central banks that are so important to our corporate Treasury clients.
Certainly. It seems as though at this point it's the U.S. and the U.K. on one side, Tony, with, pretty positive growth and, at least in the U.S.'s case, an increasing rate environment, or at least a liftoff. The U.K. hadn't gone as low as the U.S., so we're a bit in parity at this point from a U.K. standpoint, whereas Europe, on the other hand, has, continued to be negative on a short-term rate basis and go even further into that negative territory. Our outlook from a U.S. perspective at this point is a couple more rate increases in 2016, and potentially even, into the UK getting a rate increase before the end of 2016, although that one's a little bit more conditional at this point, depending upon what else is going on from a European market standpoint. We certainly think that the Fed will take note of what's happening in the Chinese stock market and, the financial markets there. But we don't necessarily think it's any new news compared to, what we've been talking about from a game changer perspective in 2015, and certainly what the Fed considered and we think was probably the reason the Fed didn't begin liftoff back in the September time frame of last year, and that is that the slowdown in China is underway. It's certainly not, in recessionary territory, and it's certainly not something that we think will get to that point, but the slower economy has been, a reality in the market for the better part of a year now, and it seems as though what we're experiencing from a financial markets perspective so far in 2016 in China is coming to grips with that slowdown. So I don't know that it will have a huge impact on the Fed and their continuing thought process about increasing rates, above the 50 basis point level where they are today to something that's maybe closer to 75 or 100 basis points throughout 2016. And I think it will be, continue to be data dependent from a U.S. perspective, which, although it will have some impact from a world economy standpoint, we think it will continue to be pretty firm in the U.S. The fact that the markets have gone in different directions in Europe and the U.S. and the UK doesn't seem to have caused any dislocations either, which is healthy. The Euro banks that have historically gotten some of their funding in the United States continue to do that, even though you would think if they were able to finance on a negative short-term rate in Europe, why would they go with a positive short-term rate in the U.S. on their financing needs? And it's basically using that U.S. funding to fund their U.S. assets, and not having to deal with the FX volatility or the rate exchanges, currency exchanges that we were talking about in the first game changer. So that dislocation has not been at all felt from a short-term markets perspective.
Great, thank you. Now, Roger, you rate money funds, and money funds have exposure across multiple jurisdictions with diverging central bank policies. How do you take this divergence into account? And in particular, does that change the way you look at the risk and the credit quality of the funds?
Sure, Tony. Just before I answer that, though, I wanted to just pick up where Debbie left off in terms of interest rate policy. So I tend to agree with her forecast for the future path of interest rates, and certainly if you look at the Fed funds futures, they're sort of in the camp of at the lower end of Debbie's forecast. But we had done a study where we went back and looked at rate hikes over the last, really since the early 80s. And I think it's interesting because it shows you how unique the circumstances are today in terms of liftoff coming off a base of 0 interest rates, and then just, the forecast for rates going up in the future. Historically, if you look over the last 4 rate cycles, when the Fed started lifting rates, on average, they lifted them 300 basis points in successive hikes, and typically that was 300 basis points over 12 rate hike cycles, and generally that tightening phase lasted about 13 months. So clearly, the forecast is not for anything like that this time around. So I think it's just interesting to show or talk about how different this rate cycle is from historical ones. But to your question about rating money funds, clearly they're, the funds that we rate are denominated in different currencies. So we rate funds in dollars, sterling, and euros. For us, the key issue is when we rate a fund, how effective is that manager in limiting the risks that they can control, whether that be credit, market, or liquidity risk. We don't really speak to the yield on the fund. So, in the case of Europe, we have a number of funds that are in fact yielding negative. That's not really within the scope of the rating. What we're really focusing on is within that currency, given that there's always a cost to liquidity. Right now, that cost happens to be negative in Europe. It's slightly positive in the U.S. And so what we're really looking at is how does the manager control the risks that are within their capability to control.
Great. Now, Peter, your association works with treasurers from around the globe. How are they dealing with these diverging central bank policies? How are they playing the interest rates? And
I mean, I think to a greater extent, corporate treasurers don't spend a great deal of time, if you like, worrying about the policy implications of what central banks are trying to do. They have to deal with the here and now at a given point of time that they are divesting or buying companies, or they're borrowing money or paying money down, or whatever it may happen to be. Clearly, the rates in any given marketplace are what they are at the time that you've got cash to invest, or that you have to worry about your liquidity risk, or whatever it happens to be. But I don't think they particularly worry too much in that direct sense. Maybe at the next level up, where what the central bank, you mentioned Draghi before, in terms of ECB, is doing in terms of the overall economic impact on economic policy in a European context, for example. Yes, they worry about it to that extent, but I think internally and in their internal meetings, and in their investment committees or when they're presenting to board, I don't think, whilst they do get asked, what do you think the central bank is doing and what do you think is going to happen, I don't think it's necessarily going to impact on, do we sell this product, do we launch that product, do we take that new market on, do we take it off the table. I think those are different sorts of economic decisions that businesses make that aren't directly necessarily driven by what that policy environment is going to be, other than to the extent where, if you have choices about funding, for example, or investing on scale that are material to your organization, then I think you spend some time thinking what's going to happen. But if I refer back to the point I was making about foreign exchange volatility, the variety of volatility, if I can put it in that way, that we're suffering now, whether it's renminbi or whether it's Brazil or whether it's Europe, means those decisions are more complex, and you have to pay more attention to them. But I don't think they are ones where you sit there and think, what do I think the governor of the Central Bank of Brazil is going to do next? I think you look at where you are at that particular time, you make your views, or you'll take your views based upon where your situation is, where you think that local marketplace is going to be of value or not to you, and you make your decisions accordingly. I don't think you can try and second guess the marketplace, and I would probably be confident that most professional corporate treasurers don't try and second-guess a marketplace. Generally speaking, they may worry about its impact on their businesses and their sector and their business environment, but they're not going to say, I think the Central Bank Governor of Brazil is going to do X, therefore I'm going to do Y in response to it.
That sounds like great advice, Peter. Thank you. Now, moving on to the regulatory landscape, clearly in the U.S., one of the things that's front and center is the money market fund regulations implementation, which are scheduled in October 14th, I believe, and we're actually approaching the 270-day window in which 270-day commercial paper issuers may be impacted. We've seen a lot of prime fund to government conversions just in the money market space. We also want to get a European perspective there. We've seen some other regulatory things. For example, new regulations for bank capital around the major total loss absorbing capacity that actually add another layer of capital, which is good, as is another layer of cost, which is not good. And we just saw the other day MetLife signal that it's considering spinning off its insurance business, or parts of its insurance business, in hopes of shaking its SIFI designation. So the rubber's meeting the road on a lot of this stuff. I'd like to begin with Roger, who's a keen observer of the entire money market fund space, and to talk first about the U.S. regulatory implementation that's in front of us.
Sure, Tony, happy to. And I'm sure Debbie has a few thoughts on that as well. So clearly, and I think as most people know, in October we'll start to operate under a new regulatory regime for money market funds. The most, I think, notable change is that prime institutional money market funds will have to begin floating their net asset value or recording net NAV on a mark-to-market basis. And they will have to implement, or at least have the ability to implement fees and/or redemption gates. Now, we just did a survey of corporate treasurers, and we actively speak with corporate treasurers as they are one of the primary investors in rated money funds, and it's very clear from our survey and those conversations that the number one issue for them is really the fees and gates issue. They've always viewed money market funds as a very attractive option because it offered same-day liquidity, preservation of capital, and yield. And now, or at least starting in October, that free lunch no longer exists. As a corporate treasurer, you'll have to give up one of those three features based on the products that will be available to you going forward. So that is, I think, the key issue. I think we also expect to see a proliferation of new liquidity products coming to market, trying to continue to meet the demands of cash investors. And to that end, Fitch just recently published a new or updated rating criteria for money funds and other liquidity products that tries to take more of a forward-looking view as to how the markets may evolve and describe the key principles that we look at when analyzing those products.
Thanks, Roger. Debbie, I know you have a view on this, and you're actually preparing and shaping your portfolio for the implementation date. What do you see out there?
Well, we've got two different implementation dates still to come in 2016. What Roger mentioned were the major changes that will occur in mid-October of 2016. But there are some other changes that will occur, I think, that will give us some maybe insight into what to expect from a cash flow perspective from customers. Those changes occur in April. And they're changes to reporting and disclosure items for the most part. They will include reporting the information on the 4-digit mark-to-market NAV for all funds with a 6-month look-back history on a daily basis. So we'll be able to see that information for all funds, and our clients will be able to see that information for all funds, in addition to the posting of the weekly liquidity numbers on a daily basis, which are the basis off which the potential for a fee or a gate could potentially be triggered. So I think, again, the additional disclosure and the information and the volatility that might ensue in those numbers and that clients are reviewing and looking at beginning in April might be the beginning of what would be insightful information for expected cash flow. As was mentioned, the noted changes that have been provided for funds that are converting, none of which were federated, but quite a few in the marketplace, are about 80% complete. And so maybe another 40 to 50 billion will need to convert from prime to government in order to complete those that have been announced. But what that doesn't take into consideration are people who are in a prime fund that's continuing to be a prime institutional or a prime retail fund going forward in 2016, but that may withdraw their balances from that prime fund and go into that government space. So, there's been estimates that could be, several more hundreds of billions of dollars, but without any real good, I think, firmness in those estimates. And certainly it seems to be a moving target. When we initially began discussing this with clients back in, the first quarter of last year, they absolutely were affirmed that they would never be in a product for liquidity purposes that had fees or gates or a floating NAV with it. If you ask those same exact clients that same question today and you talk about yield spreads, there is much less confirmation that they would not be in that product and much more potential interest and tolerance of what would be a very unlikely situation for a product to have a fee or a gate imposed, and what would be very mild volatility with a total return mentality that was still substantially above what would be available in government money market funds, especially considering these products are all still considered liquidity products and, available to be part of the cash bucket. So, I think we still have a lot to learn, and perhaps we start to learn some of that in April. We have begun to see spreads widening in the 9 months to 1 year paper, as you mentioned, Tony. Right. That's post the October reform changes, and so prime fund managers are a little cautious about going out that far, not being certain as to what their fund sizes or cash flows will be leading up to that. So we've seen interest rates in the 9 months and certainly 6 months and under space widen, but widen basically according to what the Fed has done so far, whereas the 9 to 12 month space has certainly increased on a spread basis at this point, and that's a definitely reflection of prime managers sort of avoiding those longer dated securities for the current time period.
Yeah, and Debbie, here at Treasury Strategies, our clients clearly are less concerned about fees, gates, and floating NAV than they were 6 months ago or 9 months ago, and it's really a question of the spread between prime and government that's out there. Now, Peter, the European regs seem to, go through a sausage-making process. And I think our listeners would be fascinated to hear just what the turnover in the presidency of the commission has to do with all of this.
That's a big question, Tony. Not quite sure I can answer all of that. I think to be absolutely honest and straightforward, I don't think we are seeing a great deal more clarity yet on exactly what the outcome of the money market fund regulatory environment is going to be in Europe, partly because there are any other number of regulatory initiatives of all sorts occupying people's time, partly because I think the problems that the ECB is having in terms of driving economy and all the rest of it has meant that what corporates do with cash and what people do with cash has come off the agenda. As an interesting aside to that, although in the UK we are having to worry about it that little bit more because of issues like bank resolution and ring fencing, which are coming towards us ever increasingly in terms of 2019, I think in continental Europe the pace of that change has slowed somewhat, so it's come off the agenda a little bit. As an aside as well, there's been a lot of pushing in Europe into, or trying to push corporates into repo markets, which for some works, for others don't work, and for some is still a difficult market to go into for any number of variety of reasons. Whether they should or they shouldn't is a different matter. I'm not commenting on that. So I think there's a number of issues there which aren't making it absolutely clear as to what the circumstances are. We know, for example, that making everybody VNAV and not having any CNAV anymore is something that people are still thinking about again, even though probably what you'll end up with is some sort of hybrid CNAV, VNAV, possibly with fees and gates. Interested to hear what Roger says there about people less concerned about it. From what I understand, I think people still are concerned about it. But as I say, I think in the regulatory context, money market funds are not quite top of the list again at the moment. It seems odd. I mean, I'm not sure whether that necessarily the change of presidency, which takes place every 6 months in Europe and to a great extent is ignored for the purposes of financial services regulation, simply unless somebody comes in with a particular view. It's not something that comes up to the top of the list. Just as a last point I'd make is you've got, transfer pricing and the tax issue has suddenly come up the agenda in terms of people's focus for European ministers and for the European Commission. The whole picture is still clouded. All it does mean in one single sentence is there is more regulation coming. There is more regulation in front of us in 2016 than we thought possible from 2014 and 2015. It's a big picture that's got a lot going on in it.
Thank you, Peter. There's certainly a lot that we need to keep our eye on here. The last game changer around widening credit spreads, and particularly with respect to high yield debt, we actually talked about that a couple of times already. Let me just throw this to Roger for a closing comment on that game changer, however.
Well, there's no question, Tony. Credit spreads have widened. Probably the biggest catalyst was in early December when the Third Avenue Credit Focus Fund halted redemptions and said it basically, couldn't find a proper price for its portfolio, and therefore it was going to stop making redemptions or honoring redemptions. That created a bit of a backlash in the high yield market. And China has continued, I think, to contribute to that with concerns about slowdown. The one thing I would say about the Third Avenue Fund is we believe it was a bit of an outlier. We did a study of the securities that fund held versus some of the largest high yield funds in the marketplace, and we used ratings and valuation methodology, i.e., what percent of the portfolio was valued as level 3 assets, and it was clear that the Third Avenue Fund had a very high portion of its assets in what would appear to be distressed or less liquid assets, whereas that's not the case for most other high-yield funds. So this may have been a case of an open-ended mutual fund, or really I would say sort of a closet hedge fund operating as an open-ended mutual fund.
Interesting, Roger, and that certainly implies the corporate treasurers need to maintain access to liquidity, particularly with the defaults that you talked about earlier, button up their treasury management and manage their sources of funding. Well, thank you all very much. We'd like to thank our panelists, Debbie Cunningham, Chief Investment Officer at Federated, Peter Matza, the Engagement Director at the Association of Corporate Treasurers, and Roger Merritt of Fitch Ratings, and Kevin Ruiz, my colleague here at Treasury Strategies. We're all interested in helping you achieve your 2016 objectives, so please, we encourage you to apply what we've discussed today, and we'd like to hear from you. Let us know how you've applied these concepts, and also let us know how we can help. We invite you to tune in to our State of the Treasury Profession message on Tuesday, January 26th. That's our 11th annual. Each year, Treasury Strategies lays out its vision for the key agenda items that we hear from our corporate Treasury clients. Everyone on the call today will receive a copy of the deck within 2 days, and next week our response to the questions and comments. And if you have any additional questions and comments, please fill in the comment box right now. And within a day, this video will be up on our YouTube link. So go into YouTube, search Treasury Strategies, and we now have about 60 different items up there across the entire Treasury and banking spectrum for you. The next cash briefing is Thursday, April 14th. We thank you very much and look forward to hearing from you.